Oman makes history as the first Gulf nation on the verge of introducing a personal income tax, and this is a landmark shift in the region's tax-free landscape. So what does this mean for investors? What does it mean for expats? What does it mean for businesses? And the bigger question is, which many people are asking now, will other GCC nations follow, for example, the UAE and Dubai? Hi, this is Marius from Global Freedom Solutions. I left Germany several years ago. Previously, I worked for several years at KPMG, among other things, as a tax consultant with an international focus. And today we help wealthy individuals, international entrepreneurs, and investors to significantly reduce their tax burden, protect assets, and find the best banking solutions. And since I have moved overseas, I am living a life that is a lot better than the life that I had back in Germany. I still love Germany and am grateful to Germany for many things, but I am simply much happier abroad. And in this video I'm going to tell you now about life in the Middle East and specifically Oman's taxes. And in fact, Oman is about to introduce a personal income tax. So for many years the Gulf region has been tax-free when we talk about the personal level, but recently one of these countries is going to step out from this and start to charge personal income tax now. And we have other taxes in the Gulf region, namely we have a VAT which is 5%, and in the UAE we now have a corporation tax of 9%, and we will talk more about that as well, but this is the first time that one of these GCC countries is on the brink of introducing a personal income tax. And essentially Oman and its government has announced that they have a Vision 2040, and this is aimed at economic diversification. So essentially they want to reduce dependence on oil. And a lot of people are of course nervous now. They are nervous that this could be replicated in other GCC countries as well. And essentially the introduction of this could affect a lot of families and people looking to live here, families already living here. And it could also affect corporations and how they can attract talent to come and work for their companies in the Middle East. Initially, the personal income tax in Oman was expected by January 2025, but has been delayed, and there is a two-tiered tax system that they've introduced, which is going to be between the Omani citizens and the expatriates. And initially, this personal income tax law was supposed to start for expats and non-residents from $100,000 per year, and you are supposed to start at 5% and go up progressively up to 9% depending on your tax bracket. If you are an Omani citizen, you would be taxed only if you are earning more than $1 million in global income. So essentially that's all types of income, so not just salary, and it would be dividends, it would be rental income, it would be all income, and that would be a 5%. What happened is that there was a bit of back and forth with the state council. They announced that they would be landing on an income exemption limit, which is raised to $130,000 per year as a way to kind of protect the middle classes, and the flat 5% tax rate is going to be fixed, essentially progressively increasing up to 9%, as I mentioned before. And this should also reassure many who were previously very concerned. So tips and end of service benefits shall also be excluded, and that can be a large amount of money as well. And one of the key benefits that you get as being an expat in the Middle East is that your retirement payouts and your end of service benefits will be excluded from this taxable income. Also, this isn't a nice pill to swallow that you didn't have to pay taxes on private income for years and now all of a sudden you have to pay 5% personal income tax. These tax exemptions are quite attractive to a lot of people and make a lot of people less panicked. So let's talk about the advantages of this personal income tax introduction. First of all, Oman reduces its dependence on oil revenues, which supports its long-term economic stability. Essentially, Oman is going to be able to fund public investment infrastructure, social security, social services overall the public sector, and also help to redistribute wealth to be able to raise the living standards of everybody within the country. And this personal income tax could also boost the country's credit rating, improving its global reputation and making it easier to attract foreign direct investment. One downside is that it could also lead to some capital flight, so you might see high earners and expats deciding to leave for countries where personal income tax isn't a concern, like the UAE or Qatar, for example. But that said, I would caution you that while Qatar's cost of living is similar to Oman's, the UAE tends to be more expensive, and when considering Oman though, it offers a slower pace of life and a more nature-focused lifestyle. Essentially, it's perfect for those who enjoy the quieter side of life with beautiful beaches and a smaller, more laid-back population. So you won't find the skyscrapers you would see in places like Bahrain, the UAE or Qatar, which could be a big plus for some. And there's something nostalgic about Oman for people who have been in the region for a long time. Basically, it feels like a throwback to the older days with a more relaxed vibe that you don't get in the modern, fast-paced financial hubs of today. If you ask me personally, I like the idea of spending a weekend there to escape the hustle, but that's just me, so everyone has different preferences. So some people might choose to leave, while others are fine with staying and paying this personal income tax. So let's shift to corporate tax in the region. As most people know, the UAE has introduced a 9% corporate tax. Saudi Arabia, on the other hand, recently introduced a 20% corporate tax. But if you have a local partner from Saudi Arabia or the GCC, you will only need to share a portion of your profits with them rather than paying the corporate tax directly. So some people opt for that route as well. Qatar has a 10% corporate tax, and if you look at VAT, the UAE and Oman both have a 5% VAT. Saudi Arabia started with 5%, but during COVID they raised it to 15%. Bahrain also had a 5% VAT, but that's now 10%, and Kuwait and Qatar haven't adopted VAT yet. And when you see that Qatar already has a corporate tax and Oman has personal income tax, it's clear that these countries are exploring various ways through corporate, personal and value-added taxes to generate revenue. And some people worry this is just the beginning of more taxes coming for everyone. And to that, I say it's really up to each country how they handle it. If you have benefited from these tax systems so far, that's the point of this channel. We are showing you countries with opportunities. The doors are open, but you have to act before they close. And yes, tax rates could increase in the future. The UAE has said they have no plans to introduce personal income tax, but that doesn't mean they won't consider it in the next 5 or 10 years. And that's why it's essential to make decisions based on the present, but also be prepared for what might come in the future. And this is why I often advise people to have more than one passport, more than one residency and multiple options. The world is changing fast and opportunities come up, so always be ready to act on them. If you look at comments from leaders in the space, like those from Oxford Economics, for example, they all agree that these tax changes are in line with what they expect for future taxable revenue. So governments are likely going to continue looking into these options. Despite the tax changes, I think Oman will likely benefit from this move. The revenue collected from taxes will allow the country to reinvest in itself and improve quality of life, unlike in Europe, where bureaucratic inefficiency and wasteful spending are common. Essentially, many people criticize how Europe handles taxes, and some wish for figures like Elon Musk to come and overhaul the system. And countries like Greece, Italy and Portugal have already proven that it is possible to offer tax-friendly programs like lump sum payments or non-habitual residency programs, allowing people to live tax-free in Europe. And one country that has made a huge mistake in my view is the UK. The decision to close its non-domiciled tax program was completely wrong. This has created an environment where many wealthy individuals are choosing to leave the UK, and in addition, the UK is currently also considering the introduction of an exit tax. So you can think what you like about the probable personal income tax in Oman, but in Europe, or especially in the West, things are many times worse in terms of tax development. So if you are looking to move abroad and build a life elsewhere, I've done it myself and can guide you on how to not only relocate and save taxes, but also build a better life, measured not just by finances, but also by quality of life, travel, and cultural experiences. With that said, I hope you enjoyed the video. Leave it a thumbs up, subscribe to our channel. See you in the next one. Bye.